Warren William here from Smart as Data with quick definitions, helping you understand the stock markets, the language, jargon, and all its intricacies. The discount rate. Okay, there are two. In this video, we will discuss the discount rate linked to the Federal Reserve. What is the discount rate? Does the Federal Reserve set the rate or suggest the rate? There are key differences. So what are the objectives in changing the discount rate? Let's go to the video, define and explain what is the discount rate. At the end of the video, there'll be 3 quick bullet points to take away. The Federal Reserve could make available a short-term credit facility to member banks via the discount window. The interest rate offered on the facility is the discount rate and is an instrument of monetary policy. In the US, there are two main avenues for the US banks to obtain a credit facility for the short-term financing needs. First, via the interbank market, so between the US commercial banks. This is the more common method for banks to cover their short-term financing needs. Second, the Federal Reserve Bank could offer a short-term credit line via the discount window. The credit facility is made available to cover any near-term liquidity issues due to a shortfall in cash, or to prevent the possible failure of a bank. The interest rate charged on the short-term lending facility available to member banks via the Federal Reserve is known as the discount rate. This is one of the methods by which the Federal Reserve manages monetary policy in the US. The Federal Reserve sets the discount rate by raising or lowering the rate. When the discount rate is reduced, the objective is to increase money supply by reducing the cost of borrowing to stimulate lending. An accommodative monetary policy, or dovish. The opposite is hawkish. The end goal is to stimulate economic activity to avoid a possible recession. In 2007-2008, the discount window was widely used as the financial conditions of some US banks deteriorated sharply. To stimulate the economy, the Federal Reserve injected liquidity into the financial system. One way was by lowering the discount rate. The Fed funds rate is another interest rate under the Federal Reserve, which is the interest rate suggested by the FOMC. In closing, 3 quick bullet points regarding the discount rate. The interest rate on a credit facility to the banks offered by the Federal Reserve. It is an instrument of monetary policy to manage the money supply in the economy. Stability of the financial system is one of the key mandates of the Federal Reserve, and an expansionary or restrictive monetary policy is managed via the discount rate and also the Fed funds rate.